A good day, guys. A quick run on what to know when to hunt a fair value gap. The model we are talking of, this particular model called the fair value gap, it was a model that was invented by someone. And to be fair, it deserves all the accolades because in the forest industry today, many people have been reaping from what they did not sow. Many people just come out, I invented this, I invented that. But the real author of this fair value gap model is the ICT himself. The one you are looking at your screen here. This is the ghost in the machine. So that was why I gave him the accolade. I said the presentation will be based on how to use the fair value gap. The credit and accolade of this model goes to the ghost and the machine in the person of Mr. Michael Joe Odestein. The ICT himself, he is the author of the model. He has several models he invented, he authored. So I said you are much appreciated in the trading industry, even though many people do not give you the accolades you deserve. I personally, I give it to you, and the credit remains yours. Now, a quick dive into what to know when to hunt a fair value gap. So, know the order flow. You have to know the order flow, have the clear direction, have a clear understanding of the higher time frame direction of the market you wanted to trade. So if the market is bullish on the higher time frame, it means you will be watching for bullish fair value gap on the lower time frame. If the market is bearish on the higher time frame, it means you will be watching out for a bearish fair value gap on the lower time frame. But in this illustration, we'll be using the bearish order flow. What do I mean by bearish order flow? The moment you go to your higher time frame and you discover the candle is just coming down, coming down, coming down, coming down. On higher time frame, do you want to be precise? You should know the order flow is what? Is downward movement. You can see it's a downward movement. So in a market like this, why do you need to go on long? For what? What do you need a long position for? If personally, not that I can't trade long in a short in a bearish market condition, but in a case I wanted to go long in a short market condition, I have to reduce my risk, and to be candid, it will only be a scalp. I will not go on long. I will not go on long in a bearish market condition and stay there. It will just be a kind of scalping. So time to hunt for fair value gap. In trading, time is very crucial. For market signature hunting, there are economic news that comes out at some particular time of the day that will determine what and what not to rely on. We have high, medium, and low impact news. We have different types of economic calendar, but I prefer forestfactory.com. So Specific time to hunt for fair value gap are as follows: 1, 2 a.m. to 3 a.m., 8 to 10 a.m., and 2 p.m. to 4 p.m. Everything should be converted to New York time in any part of the world you are watching from. So the only thing you need to know, you need to do is what is 2 to 3 p.m. 2 to 3 a.m. New York session in my own time. In Nigeria, it will be around 9. Present, I think, is around 9. So those specific time, at times you expect movement, volatility, significant movement in the market. You don't just go to your chart and trade because you feel like trading, or you are less busy, you just want to do something. If you are less busy, you want to do something, it's better for you to tape read. Just glance, be glued to your chart and see how candle forms. But if you are interested in pushing a button either on demo or the real account, there are time and what to watch for. The next thing I mean, visually clear liquidity pool. Price only runs for two things in order to be efficiently delivered: either for liquidity above or below the market price, or to an imbalance. What I mean by that, market going to stop out some people. The market will go for stop hunts, or it goes back to fill up an imbalance in form of sell side imbalance, buy side inefficiency, or a buy side imbalance, sell side inefficiency. So watch out for where the liquidity lies in the price. From the picture I have here, this is a sell side liquidity pool. This is a sell side liquidity pool. Then the market dips its hand into the sell side and stop out some sell stops, which is this. Sorry. Now get on the next slide. What I mean by that? Oh, I want to clear something. I want to clear the impression of the other one. Let me. This is a sell side. This is a buy side. Why are there liquidity lying above that place? Those two areas, some people would have entered a buy trade here, and they will have their sell stop somewhere around here, somewhere around that rectangle. So the market will come down, top them out. They are in buy, but it will hunt for their stop loss, take them out, and still go back to their direction. So what we do as an ICT student, we wait for the stop hunt to take place, and we target the next liquidity pool, because for every buyer there is a seller. So I also have another double top here. I expected some people to might have entered a sell trade here and have their sell limit, their sell stop loss their sell position stop loss, they will have it around that double top, because the lecture many of us came up with, even I myself, is that when you see a double top, on the next movement, enter a what? Enter a sell. When you see a double bottom, on the next touch on that area, you enter your what? Your buy. So as an ICT student, you what? You target that double top as your what? As your take profit whenever you are in a buy position. Then the next one, wait for market structure shifts. What do I mean by market structure? Market structure shift is a kind of a way to recognize if the market has, or if the market is ready, if the market is ready to go its way. You know, we are using bearish as an example in this lesson now. The market might start bullish in the early hours of the day, just like what was happening here. In the early hours of the day, the market was going high. At some point, it started dropping. The BSL here, the BSL here means buy side liquidity. So there is a buy stop lying around that place. Either a buy stop to join the buy movement, or a sell stop to an existing sell trade. So the moment neophytes saw the market start rallying, they will have buy stop there. Okay, expecting it to move in their direction and join the trend. But as an ICT student, I knew it's a sell day. The order flow is what? Is sell. Why do I need to enter a buy? The market going on buy is giving me an additional opportunity to approach the market to start selling from a premium. So when the market starts dropping, others are building up here. Others are building up here. So we have hunts there. We have sell side liquidity there. On the next candle, the market pushes it. Wow. It takes it out, then it dropped. It takes out that stop once, then it drops. Now, the market dropping, does that really now mean I have to start pushing the button to enter a sell trade since I'm interested in selling the market? No. There is a signature you need to see before you engage the market. What is the signature? Now, the market dropped significantly, but to your left hand side, there is a swing low here. There is a swing low here. What you need to observe is to make sure the significant drop here takes out this low. Not that it will take this out with a wick, but a significant candle should be the one you use in deciding your market structure shift. They call it breaking market structure. Now, the market structure shift is an automatically changing the direction. So the moment I see something like this, I wait. Once this low is being taken out by this black candle, I wait. Then I observe the black candle. Does it have a fair value gap? I see it does. The low of this green candle and the high of this black candle, there is a gap that existed between the both of them. So this is my fair value gap. What next should I do? I said scale down to your smaller time frame to check for available market structure shifts in sync with the higher time frame direction. We are going short in this illustration, so I have to go down to a smaller time frame, then check for my market structure shifts. If you are expecting a lower market movement, which is bearish, you watch out for bearish fair value gap, just like what we have here. This is a bearish fair value gap, and it's also called a CB, sell side imbalance, buy side inefficiency, SIBI. And you expected that CB to act as a resistance to price. You can see when the market traded to it, the market was unable to close above the fair value gap. If you are expecting a higher market movement, which means you are expecting a bullish movement, you watch out for a bullish fair value gap or a CB to act as a support to the price, which is a vice versa of what we have here. Now, before we move on, so the moment I discovered the market has given me a market structure shift, I wait. Then I watch the next candle. Does it trade and fill in this fair value gap? No, it does not. So on the third candle, the first one was the initial drop, the second one was this. So the third movement, since I have a fair value gap already, on the third movement, if the third movement traded back into the fair value gap, I will enter my sell. I will enter my sell position. But from this illustration here, before we see a movement back into the fair value gap, it was after how many candles? 1 2 3 4 5 6 7 8 9 10. That was after 9 and 10 candles. So you don't engage the market blindly. You need to have certain rules to follow before you enter into the market. I have a bias. I have seen a liquidity run or a stop run, a stop hunt in the opposing direction of the higher time frame. Then I have seen a market structure shift. Then the market has given me a fair value gap. The next thing is for me to wait for the market to revisit the fair value gap. If the market does not revisit the fair value gap, I don't have a trade. It's as simple as that. Then I see the market has given me an opportunity to enter in the fair value gap. The market has retreated back into the fair value gap. I have entered my trade. Now, my placement, my stop loss placement, and my take profits. Your stop loss should be placed above the swing high. In this case, it will be a swing high because we are going down. A swing high. This is the swing high. The swing high or low of the stop hunt that forms the market structure shifts where the fair value gap forms. This was the leg. This was the bearish candle that forms my what? That forms the market structure shift that breaks the structure. So this was the wick that was formed with the stop run here. So my stop loss is where? My stop loss is expected, sorry, my stop loss is expected to be above, to be and remain above that swing high. It should remain above this, what? The swing high. Now the question will be, what if the market traded back into the fair value gap and still stop me out? It can happen, it may happen, and it will happen. What does that mean? You sit idle again, wait for the next time and check for the same signature. Check for the same signature. That does not mean the model is flawed. It does not mean the model is not working. It does not mean the model is fake. You only read it wrong, and there is no crime in that. You will have a losing trade. What matters is that you have a protective stop loss. So your take profit target should be the next available sell or buy stop hunt in form of a single or a double swing low or high, or the next opposing imbalance in form of what? Fair value gap. Now I entered on this fair value gap. I have my stop loss here. Where should be my target? My first target will be this swing low. My next target will be this swing low and the consequent swing lows on that time frame. In the case there is an imbalance like this, I might also use it as a false target. But in a nutshell, my stop loss will be at the swing and I'll be targeting another swing for my take profits. So I wanted this video to be a very short one, but it's been elongated by the explanation. So I think with this you would have known one or two things to do whenever you want to hunt for your fair value gap. You are feel free, you are free, sorry, feel free to drop a comment to ask your question. There is nothing like a foolish question. Any question at all will be attended to. Then in closing, in closing, in closing, thank you for staying to the end. Like, share, and subscribe to our YouTube channel. Feel free to ask your question in the comment section. A quick disclaimer: I am not a licensed trade advisor. I'm not a licensed financial advisor. Result from this video on this channel does not guarantee your results in live trading. Take responsibility for your actions. So everything said in this video so far for is meant and is only for educational purpose. Making decision or financial decision with it will be a decision you make by yourself. So thank you once again, and have a lovely day ahead and a productive week this week. Thank you.